Look at the current price of gold, and you might assume you are watching a standard market rally. Underneath these all-time highs, however, is a deviation from economic logic that has forced a total rewrite of the professional playbook. This chart shows how gold has historically been priced. For decades, the metal moved inversely to U.S. real interest rates and the dollar index. When the dollar strengthened and interest rates climbed, gold went down. Then, in 2022, the correlation snapped. Interest rates climbed, the dollar held strong, and instead of crashing, gold surged right alongside them. A financial framework that governed the market for over 40 years simply stopped working. The question is, why? Gold has moved away from its traditional economic cycles because the primary reason major global players are acquiring the asset is changing. To understand exactly what's shifting, we have to establish the baseline. Between 1978 and 2015, gold operated as a cyclical asset, driven by inflation metrics and predictable consumer behavior. Take the 1978 to 1980 bull market. Prices rose in response to stagflation and global energy shocks triggered by the second oil crisis. That run ended when Federal Reserve Chairman Paul Volcker raised interest rates to 20%, curbing inflation and pulling money back into yielding assets. We saw another supercycle between 2001 and 2011, fueled by China's entry into the global commodities market and geopolitical anxieties following September 11th. Beyond those macro waves, price movements were tied to the calendar. The first quarter was consistently strong due to the physical demand of the Chinese Lunar New Year and the Indian wedding season. This heat map illustrates that seasonality. We see a concentration of price increases in January and February, followed by a liquidity lull in the summer and a spike in the autumn as merchants restocked their jewelry inventories. For nearly 4 decades, if you tracked inflation, Federal Reserve rate cycles, and consumer seasons, gold behaved largely as expected. That cycle shifted after 2016. Seasonal jewelry buyers and financial traders lost their pricing power to a massive new category of buyer: global central banks. This bar chart compares official sovereign gold demand over time. Prior to 2010, net purchases were secondary to the market, but starting in 2016, emerging market central banks pay attention to the cluster on the right. These institutions keep buying even as the cost per ounce hits record highs. They have moved from tactical traders to strategic hoarders. Beyond purchasing the metal, these nations are physically relocating it. In a trend known as repatriation, countries are withdrawing their physical gold from offshore storage in London or New York and locking it away in domestic vaults. When central banks buy thousands of tons of heavy metal and move it back to their own soil, they drain the physical supply from Western trading hubs. This mass removal of liquidity creates a structural support level for the asset's price that didn't exist in previous cycles. The motivation behind this hoarding stems from the recent weaponization of the global financial system. When foreign exchange reserves can be frozen in response to geopolitical conflicts, the assumption of absolute safety in offshore assets changes. The post-World War II dollar-centric system, established by these delegates at Bretton Woods, is fracturing. Emerging markets now realize that holding a unipolar currency carries tangible judicial and counterparty risks. This diagram illustrates the new financial calculus. Traditionally, gold was penalized because it offers zero yield, unlike a bond that pays interest. Today, institutions are prioritizing the trade-off. A physical gold bar has zero yield, but it also has zero default risk. It cannot be canceled or frozen by a foreign government. Because of this physical security, gold is stepping in as the neutral asset for decentralized trade networks. It provides a foundation for nations conducting commerce entirely outside the US dollar. The gold price is no longer just a metric of inflation or seasonal jewelry demand. It is a mathematical visualization of a world preparing for a fragmented global order.